All right, we are live. We are up and running. It is straight up the top of the hour. Probably get started in about 2 minutes just to give people time to get logged in and get all that kind of stuff done. This is Frank Gray with the National Real Estate Post. I'm here with Barry Habib, MBS Highway, and Tom Hutchens of Angel Oak Mortgage Solutions. We'll be walking you through a really cool webinar this morning and just wanted to get things lit up and started and running before we actually get going here, which will be in about 2 minutes, just about 2 minutes. So while we're waiting, you can enjoy our playful banter amongst the three of us. So, gentlemen, any playful banter?
Hello, everyone.
Hey Tom, hey Frank, it's Barry. It's really good to be with you guys. Everybody who's on the call. It's gonna be fun 45 minutes. I'm glad that we're all together on this.
Oh yeah, this is gonna be a good one. Yeah. So it always is fun. We always have a good time, and it's always great information. This ongoing webinar series with Angel Oak has been fantastic. We've had nothing but great feedback on it, and of course, the few times that you've been able to jump on with us, Barry, it's always been that much better. So
thanks. I'm really glad that that we're able to do this, because I think that as people will hear from the call, it's very indicative of the times that we have. We really have to shift our thinking. And there's so many ways to create additional business that people just aren't really thinking about right now. It is a different time that we're in.
yeah, it is, and it requires different strategies. It requires different thinking, and it requires different activities. Everything. It's like when markets get tight, things just come to light, and we really have to buckle down and become good salespeople again. And so,
Well, I think also, Frank, this time of year, end of the year, everybody's kind of now starting to think, okay, we're about to put 2018 to bed. Let's make plans for 2019. So good timing to have these kind of discussions as well.
absolutely. But that we are at 2 minutes past the top of the hour, so let's go ahead and get started. I see Barry's already shifted over to market updates. I'll go ahead and officially kick us off. This is Frank with the National Real Estate Post, here with Barry Habib with MBS Highway, Tom Hutchens of Angel Oak Mortgage Solutions. Welcome to our webinar here, New Strategies for a Changing Market. We're going to be chatting with Barry, chatting with Tom, myself, kind of going through some thoughts for you guys. Like Tom said, heading out of 2018 into 2019 with some new ways of thinking and some new things that we can do to generate some new business. So with that, I am going to go ahead and do a couple quick housekeeping items. Number one, do us a favor, guys. We are recording this. However, keep in mind that sometimes GoToWebinar recordings don't work. They fail. And so with that in mind, definitely want to shut off the phone, ignore the emails, take notes, and pay attention. We are recording it. If it fails, though, at least you've got your notes and your thoughts from this webinar. But with that in mind, it should be good. It should be fine. So we are recording this. That's always a frequently asked question. Yes, we're recording it, and yes, you will get a copy of the recording. But I would still pay close attention, because in the event the recording doesn't work, you're good to go. The other thing is questions. Go ahead and fire questions away as we go through this webinar. You should have a little questions box somewhere on your screen. You can drop questions in there. Just feel free to drop them in as we progress through. We will be looking at those questions. I will be as a moderator here, and I'll be checking on them, and I'll be dropping them in as I see that I can, based on how the flow of the webinar goes. But at the end of the webinar, we'll try to field them all, or as many as we can. Now, the other thing is if your question does not get answered at the end or during the webinar, don't worry. All the questions are recorded, and they are being sent to Angel Oak, and Angel Oak will reach back out to you and answer those questions directly for you. So you don't have anything to worry about there. I think that's all I wanted to go over as far as housekeeping is concerned. So with that, we're going to hand it over to Barry to start this presentation. Of course, Tom and I will be chiming in as we progress along. We're going to see some very interesting stuff, and after that, we're going to go through some additional scenarios with Tom, and then we'll wrap it up at the end. Whole thing should be about 45 minutes, 50 minutes, guys. So with that, I'm going to hand it over to Barry Habib. Barry, take it away, my friend.
Yeah, well, I think we're all in this together. I mean, we just wanted to talk about some of the things that are going on, right? I mean, rates have increased a bit, and that's caused refinances to drop the most recent numbers are so 40% drop and the lowest level since the year 2000. So we're talking about more than 18-year lows that we have seen in the amount of refinance transactions done. And I think that's taking a toll on many companies out there. It's also many individuals are searching for ways to make that business up. They're soliciting real estate agents and other referral sources that we have, and it's causing us to have to look for ways to gain more business. Don't you guys think so?
Oh yeah, absolutely. We over here at the National Real Estate Post, we're connected to so many mortgage companies, and we're definitely hearing them feeling the pain, as it were. And they've been reaching out to us for all different types of ideas to move forward. That's why I'm glad we're doing this webinar today.
Yeah, and I think just even a couple months ago, Barry, the NBA came out and said over 90% of the outstanding loans had no incentive to refinance. So, that's a reality, and that was a few months ago, and rates have moved even since then. So it's really important that originators get kind of change their business model going forward.
Yeah, I mean, we're sick of hearing about margin compression, but that's just a function of the fact that you have excess capacity, and there's a lack of business primarily driven by refinance transactions, which have slowed. But Frank, you've talked a lot about this, and Brian's talked a lot about this. There's ways to gain these refinance transactions just by being creative,
Yeah, definitely. And a lot of that's just come from hanging out with you, Barry, and doing presentations with you and seeing the webinars that you've been doing, et cetera. It's eye opening to understand that, wait a second, there's 12.5 million homes out there that have 50% equity in them right now. And there's ways that can be taken advantage of for these people that still truly help them out, even though they might be bumping their rate. So that's what we've been trying to convey, is trying to let guys know, just like you have up there, that we need to really take more of an advisor position. If we haven't already, we really need to step up and start doing that and digging deeper into people's files and their financial situation to see if we can still help them, even though off the cuff, it might not seem like it's a smart thing to do, but in reality, it winds up, yes, it is a smart thing to do.
Yeah, I couldn't agree more. There are ways to gain business in this market that just are causing us to have to look a little bit differently. For the last 9 years, it's been a fake market because you've had the Fed propping asset prices up and buying mortgage bonds and buying treasuries and keeping interest rates artificially low. So now we're experiencing more volatility because the Fed's not buying. And at the end of the year, when the ECB stops buying, that will even add to the volatility that we're experiencing right now, where you're seeing more price fluctuations, more volatility. And it seems a little odd, but this is actually what a real market feels like. You just have to go back 9 years. Some people have had their whole career, guys, and not experience what a real market looks like. You think about that, right? And people in management, people on the front lines, they don't know what a real market is because they can be very experienced, 8 or 9 years, but you need to be here longer than 10 years to have experienced the real market. And even then, it's something that some people are forgetful of. And you do have to respond as an advisor, but I think it requires new thinking, guys. Don't you, on move up purchases and refinances?
No doubt. I think the advisory concept is a new way of thinking, and that's what's really great timing about this call. These are the things that we're going to talk a lot about. So good stuff.
Yeah,
Sorry, Frank. Go ahead.
No, go right ahead.
Well, what I was going to say is one of the things that I hear very often from real estate agents. I'm fortunate. I do a lot of speaking with realtors around the country, and I know, Frank, you obviously through the National Real Estate Post, you have tremendous interaction with realtors. One of the biggest problems that are facing real estate agents today is that they have a situation where their customer is desirous of a move-up purchase. But because they purchased their current residence a few years back, the rate was much more attractive, and also home prices have gone up. And if they want to go to the next category of home, they have to spend more two ways. The mortgage they're going to take is bigger on a new home, and the interest rate, they're going to let go of a very low rate and move up to a higher rate. And that's giving them a lot of payment shock. Are you hearing that? I'm hearing that all over.
There is no doubt that's a reality, Barry. And like you said, realtors are the front line, so they see it every day when they're talking to the prospective buyers.
So let's go over, everyone on the call, let's go over kind of an example and how you can do some of this new thinking, okay? So let's review what a scenario might be on a move up for a family to a higher priced home and a higher interest rate. So we're going to take this step by step, and we're going to go with a real scenario. And Tom, this is one that you brought to us that we'll kind of go through. And a family wants to buy a home in Atlanta, Georgia, which is you folks' hometown there, right, Tom? You're in Atlanta.
Yep.
I was actually there yesterday and the day before speaking. I'll tell you what, Atlanta's great. We didn't have the greatest weather when there, but boy, oh boy, I didn't realize how much traffic you guys have there these days. But
rain's a factor.
yeah. But it is awesome. It's going to be the home of the Super Bowl this year. I'll be there for the event. But so a family wants to move up to a home in the Atlanta area. And we're just going to pick Atlanta. Look, it could be anywhere. Now their monthly qualifying income is $12,000. Their FICO 700. So this is a nice loan here. And the terms of their current residence, so where they live right now, right before they move. So they purchased this home that they're living in today in January of 2015. So, 3.75 years ago. And the purchase price was $400,000. Now, their original loan was an 80 LTV at $320,000. And here's the thing, guys. Their rate, 3.75% on a 30-year fixed. So this is one of the big problems is their payments based on 320 at 3.75 for 30 years. So their PITI is 1482, which is, that's pretty darn low, right? Now, through normal appreciation in this market, and it's going to vary a little bit from market to market, but we've been averaging pretty good appreciation for the past 3 years for much of the country. So you're going to see similar stories. A $400,000 home that they purchased in January of 2015 today is valued, and we went with the actual numbers, Tom. We went 518,623 is what the actual value of that home is today. Now, they took out that mortgage of 320, right? And through normal amortization, they didn't pay anything else, just normal what it would be paid down to between the time they purchased it and today. The remaining principal balance is $296,750. So look, they've got some equity here, right? I mean, they've got whatever, $220,000 or so of equity in the home. But if they're going to sell this, they've got to spend on a realtor. They've got some closing costs. They've got to consider closing costs and reserves on the purchase. So they want to buy a home. And guys, let me ask you something. If you're looking at a home that the current value is 500 and change thousand, if they want to go up, they want to move up to the next level home, right? So they're looking to, get a bigger place or a nicer place or a couple extra bedroom, bathroom type of situations. What price range do you think that these guys are going to wind up looking at?
I don't know, 500, something like that.
Well, they're at 518 now, right? They're
probably
518 now.
600, 650.
So 600, 650. So let's just say if they're looking at a 650 purchase, right? So they want to take their equity, which is $221,000. They want to pay their expenses on the way out with the realtor and this and that, and that'll leave them about $162,000 for a 75 LTV to put down on their new home of 650, right? So this is where we are today. It's a $650,000 purchase, and let's take a look and see how this might pan out. So as we go through this here, and we just have this all pre-populated. They're in Gwinnett County, Georgia, near Atlanta. $400,000 back in January 2015. We know what it's worth now. We know their mortgage payment at 3.75. We know what they paid it down to. But now these folks have some debts. Not crazy. They're a normal family. They have a Toyota. It's got a $35,000 loan on it. They pay $643 a month. These are actual scenarios. They got a Visa, a MasterCard, a Discover, Macy's. They've got an Amazon credit card. Then they've got another car lease for $300 a month, and they've also got child support payments. Okay, so this is just your normal family. And as they look to purchase another home at $650,000 with a 162.5 down payment, we know that's a 75 LTV, and they can try and get the best rates out there today, right around 5%. Okay, but what starts to happen is when we look at trying to do this, the first thing we see is that they've got some payment shock.
Yikes!
Wow. Yeah. It's going to cost me $1,400, $1,500 a month more to buy this new home, and perhaps they're thinking, maybe I'll put the brakes on this deal.
Right.
Now, look, a good advisor, guys, a good advisor is going to say, well, why don't we do this? Why don't we borrow some more money on the purchase and pay down some of your debts? Look, if we paid off that Toyota, if we paid off that Visa, MasterCard, Discover, Macy's, we pay off that Amazon, we'll leave the car lease and the child support, and we could get into that home pretty darn close to where you are today. We can get there pretty close to where you are today. And the only problem with this, guys, is that you'd be at an 85 LTV. Your back ratio would be 50. Even if you put more in there, maybe you can knock it down a little more. And somebody's going to say, hey, I can't do that loan, right? That's not possible. And that's why we say in new thinking. And what can we do for new thinking on this? And one of the things that Angel Oak provides is certainly you guys have the ability to do this exact situation, this exact transaction where we have this issue, we have this problem that comes up where their challenges are giving up that low rate, paying off their debt, avoiding the payment shock, that they can do this with a 30-year fixed rate. Even though it sounds like it's more expensive, at 6.5%, you allow 50% DTI. We could pay off all their debt. And you can increase the loan up to a 90 LTV with no MI. So the huge amount of MI will definitely make this rate seem a lot more attractive and a lot more in line. So let's see how that kind of plays out. So let's put that in there. So we set a 6.5% interest rate, and we're going to get rid of that MI because you guys are self-insured. And let's see what that does. Well, here's the result. This is an approvable loan because you could do up to a 50 LTV. You could even take it up to a 90, so you even got more room on the LTV. And they could pay off all their debt, get into the home that they want to be in, their dream home, what they really desire to do, and the monthly payment is $61 more than what they're spending right now. I think what's really surprising and shocking about this is, A, that these situations are out there and you could do it, and also that you can do this and make it so attractive with a rate that initially might seem high, but because of the no MI and because of paying off the debt, it's really a great deal for them at 6.5.
Well, Barry, what's interesting, and this is a phenomenal tool that you've built, is that area that talks about current versus proposed. Look at that. That's really what, and the PITI. That's really what jumps out at me is that their current. We've already talked about that. That's $2,000, roughly $2,000 a month, but the new is $4,400 a month. That's where people kind of stop the discussions. It's like, oh my gosh, look at my payment for my house is going up so much, but they forget about the other debts. And that's what this tool is so, spectacular. I love it because you can just kind of click and make debts get paid off and the payments, automatically readjust. So yes, that mortgage payment goes up, but their total debt that they're currently paying is actually what? It's going to go up $61 to move
Exactly.
up from their $500 to their $650,000 house.
This is what they're paying today every month. This is what they would be paying every month and have the home of their dreams.
Yeah, I think that the big thing here is that, remember, a lot of this is being able to let a consumer achieve a lifestyle that they want. They'd rather be in that $650,000 home in the better school district or closer school district or whatever the case may be, right? It's a lifestyle that they're envisioning. And with this tool and the way you presented this, Barry, and whatnot, what we're doing is we're showing them it's an achievable lifestyle, and it only comes at a cost of $61 a month.
For a home that's worth $150,000 more, it's costing you $61 a month, and you can live where you want. You look, you only live once, right? This is, why not put your family in the place they want? Hey guys, you ever move from one place? And those of you on the call, can you relate to this? You ever kind of move someplace new that you're moving into? The closer you get to moving date, the closer you get to that time, how much do you hate the place you are, and you can't wait to get out? I hate this bathroom. Can't wait for. Can't you relate to that?
Absolutely.
There's so true.
Go ahead.
I was going to say the best thing we have going for us here is that the person wants to do it. The couple wants to do it. The family wants to do it. All you're doing is giving them permission. And that's all it says. At $1,500 a month difference, when we were talking about this payment shock at $1,500 a month difference, and that's at a 5% loan rate, by the way, that's not good. But at $61 a month difference, that's what they want to do. You're letting them achieve their dreams.
So there's a question here. I'll field it real quick. It's Shirley, and she's saying, so wait a second, is this a cash out refi done first? And no, Shirley, it's not. No. What we're doing is we're selling the home, and we're taking that equity, and we're using some of the equity to put basically 10% down on the new home instead of 25% down. And then the remaining money that we have, we're paying off all the debts. So it's a purchase deal that we're paying off debt on the purchase, and then getting the Angel Oak product because it allows the higher LTV with no MI and the higher debt to income ratio. So it's a combination of everything coming together on this purchase. And the other question that's already been asked twice, I'm just going to get this out of the way too, guys, is Barry, the website you're using to show all these calculations. This is MBS Highway, guys. This is Barry's website, MBS Highway. And when we're done with the webinar, you get your email with the recording and everything. You'll have some information on how you can get started with MBS Highway. So let's go ahead and move on, guys. I just want to get those out of the way for us there.
Yeah, exactly. And then if you wanted to, obviously, to communicate this, you could export the whole thing, or you could send it as a link that the customer can actually play with this and see what they want to pay off, which is really good. What were you going to say, Tom?
No, I was just going to say, this to me just epitomizes a new way of thinking. Just exactly what we talked about. People are like, "Whoa, wait a second. What are we doing here?" Well, we're actually becoming an advisor to a purchaser instead of a mortgage originator only.
Now, everyone listening to the call, and Frank and Tom, there's a ton of transactions that we've done in the past. I mean, goodness gracious, if you took all the people on the call and collectively all the transactions that we've done, I mean, think about how many loans that would be, right? But do you think that those people are being called for an annual review? Do you think those people are being called with thoughts of refinancing? I mean, do you think that's happening?
No, I
absolutely not.
There's probably a very select few, LOs out there that just they're good about this stuff that are doing it, but the vast majority probably not. You're right.
And the hesitancy in doing that is simply because they say, why should I call someone who's got a rate of 3 3/4 when I'm at 5%? They're not going to refinance with me, right? I mean, that's what happens. So let's kind of look at a scenario. And it's really, again, being an advisor, the best stockbrokers, they're asset managers. The best mortgage professionals, they're debt managers. And you need to be a debt manager for your past clients. And it's great to do an annual review because, look, whether you do the transaction or not, you once again become top of mind for them and you're going to get more referrals. But let's go through a real scenario. So on their current home, they've purchased a home near the Chicago area. We're going to move around the country a little bit. And their purchase price was $400,000 and their original loan was $360,000. So it was a 90% loan to value. And their FICO was 700. Their current rate was 3.5%. 3.5%, okay? But today, because of normal appreciation in the Chicago area since 2014, that home's worth $530,000. The remaining loan balance went from $360,000 to $326,900. So they've got equity in the home. And this is the case, Frank, you've been talking about this too. People have so much equity in their home because of appreciation and natural amortization. Don't just look at the appreciation, okay, because that's there. But look at the amortization. This is like $34,000 or $33,000 in amortization on top of that, okay? So we are, it's kind of stretching it on both sides. The price has been going up over the past several years, and the balance has been coming down, and gains have been made in equity. So they're thinking about a refinance, but they don't love the fact of going from 3.5 to 5%. But here's the thing, they could use some cash out. And they want to get $80,000 cash out. After all, they've got $203,000. Shouldn't they get $80,000 cash out? Now they want to roll in their closing costs. Now, we're not going to count prepaids and escrows, but just hard closing costs. And they got a bunch of credit card debt. Hey, look, this is a normal red-blooded family here. So they've got some credit card debt. Listen, people that are on this call, when you qualify somebody, most of the time, what ratio are you more concerned with, their front or their back? We all know the answer, and that's the back ratio. Why? Because people rack up debt. When you buy a home, this is not the end of your spending. This is the beginning of your spending. So they'd like to do this, but here's the problem they run into. If they did these things, their LTV would be a 77 LTV, which would be high. Their back ratio would be a 57. So this is going nowhere. But there are solutions. There are solutions that are non-QM solutions, and Angel Oak does a very, very good job of this. Let's look at this exact scenario and see how this plays out. So again, Cook County, Illinois, they purchased in April 2014. Here's what it's worth today. They bought it for $400. They took out $360. They owe $326.9, and their payment is $17.97 a month. They've got those debts that we just spoke about, okay? Now, what can Angel Oak do to help these people? The first thing that they could do is they could pay off all their debts, their Visa, their Discover, their MasterCard, their Macy's. They could pay off all the debts because initially it would cost them $760 a month more. And they pay off all those debts. And by the way, this is at an interest rate of 6.375. Okay, so 6.375. Take it to a 90 LTV, cash out, no MI, between a 49 and a 50 back ratio. Pay off all their debts. Now, you can't pay off the lease. You can't pay off their child support. Give them $80,000 in cash out. And guess what, team? Tom, you like to look at this. Here's what they're paying every month today. Here's what they will be paying. They're going to save every month $438 more than they're paying now. And they've got $80,000 cash in their hand.
So Barry, here's an interesting question that I think, looking at this scenario, just popped up, and it happens to be this: how do you counter the objection that the clients don't want to extend their short-term liabilities out into a new first mortgage?
Well, guys, that's a great question. It's something that, in fact, we should bring up to the customer before they even ask us. That's something we should mention to them, talk to them about, and explain to them. So here's, just for everybody that's listening, here's what's going on here. We're taking on debt. We're taking these debts out, which you could consider shorter term debt. Now, you don't know if they keep extending the credit cards for a long time, but for all intents and purposes, shorter term debt is being placed into a longer term vehicle. How can we rectify that? How can we justify that? Okay, here it is. We're saving $438 a month, and we're getting $80,000 in cash. So what if we said, you know what? Take the $80,000 cash. That's $80,000 more cash than you have right now. But instead of pocketing the $438 a month, what if you took that $438 a month and said, let me keep my payment the same payment I'm making now, exactly the same like I'm making my payments now, but I'm making the same payment now. I got $80,000 in my pocket, but let me take that $438 and pay down my mortgage. Here's what the result would be. So a $467, let's just go back so you can see this. So they increased their loan amount to $476,700. The rate is 6.375, right? And they'd save $438 a month on a 30-year term. So $467 a month, 30-year term, 6.375. Let's compare that, but this time let's add that $438 a month. And when we compare it, here's what we see. it would result in an interest savings of $125,000. More importantly, they would have an increase in their net worth of $237,000, and their mortgage would be paid off 104 months sooner. So this means that their mortgage would be paid off almost 9 years sooner. So they take it to like a 21-year term. At the end of the 21 years, they'd have $237,000 more. So if they're worried about their retirement or how they're going to get their newborn to college, this can show you how to do it. And remember, they still have $80,000 in cash, and they're not changing a thing from what they're paying every month. Guys, this is really powerful stuff.
That is powerful. And there's a lot of questions popping up. There's a lot of questions popping up regarding specifically, Tom, your products. So, and I know we're segueing into that section here soon. So, guys, for your questions on, what's the lowest credit score, and is this lender paid MI, and all that kind of stuff. We'll be switching over here and letting Tom take you through some other stuff where these questions are going to get answered. So take it away, my friend.
No, that's great. Yeah, no, good segue. And Barry, that's powerful stuff. Both those scenarios are real. They're out there every day. But I also thought it would be important to see some other things because there's so much opportunity with the non-QM, and we're seeing incredible growth and lots more participants this year. And then I would assume everyone that's on the call today wants to learn more about non-QM. So what I like to do is just show some real life scenarios of loans that we've closed. And non-QM, you talk to a lot of people about non-QM, and helping self-employed borrowers is a big part of the non-QM business. And self-employed borrowers post-crisis, because we know in the conventional agency lending standards, there's only one thing that you can use to qualify for a loan, and that's your tax returns. And we don't believe, and other non-QM lenders don't believe, that your tax or the tax code and how you manage your taxes is 100% indicative of your ability to repay a mortgage. And here's an example right on the screen is, and I bet a lot of originators on this call can relate. But a borrower comes in, they're self-employed, they tell you, I make $200,000 a year. So you start the application, you get the loan going, but then you get the tax returns, and you find out this borrower has perfect credit, 758 credit score, but they write off a lot of that $200,000, and that just means they have a good accountant that uses the tax code to their advantage. So they're left with $50,000 a year to qualify for a $750,000 loan, and you don't really need tools to run numbers and figure out DTI. You just know that that's not going to work. But the bank statement loans that we offer, work on that exact scenario. We're looking at what this borrower, this self-employed borrower, is putting into their bank statements every month, either their personal bank statements or their business bank statements. And that's what we use to determine their ability to repay the loan. So we gather, it's just 12 months, whether it's business or personal, you gather the 12-month bank statements. We have some really great tools that help you calculate that income. You use that income and you get them qualified, and we're going to get those loans closed for you. So bank statement loans, self-employed borrowers generally have high credit. We allow for some credit dings even with the self-employed borrowers, but the majority of what we see are the 700 plus credit type scenarios. Another non-QM is just foreclosures that aren't seasoned enough for either agency or prime jumbo guidelines. And you guys know certainly prime jumbo in this example is a $1.3 million home. A prime jumbo, you have to have pretty spotless credit for at least 5 and in most cases 7 years. But we have some of our non-QM products that allow as little as 1 day, but in this scenario they were 2 years away from their foreclosure, and we were able to get them the mortgage that they wanted. In fact, in this scenario, we were able to do that 90% with no MI that you were just mentioning, Barry. And I think, Frank, you'd asked the question, is that lender paid MI or anything? It's actually no. There's no MI and there's no lender paid MI. We are private equity, and so private equity doesn't come with mortgage insurance. So these 90% loans have no MI on anything above 80. So just another scenario. That credit seasoning is a common one. Another big piece of the non-QM space are the investors. Post-crisis, a lot of people became real estate investors, property managers. They bought a lot of properties because there were some really good deals out there. But Fannie Mae has limits on how many properties you can finance, and then back to the whole income piece. Fannie Mae requires tax returns, but if you've worked with property investors, that allows them to also take advantage of the tax code and write a lot of things off and run them through their business. So this scenario and this product itself, we're looking at the investment property and the cash flow of the investment property and kind of a debt service. So it's a more commercial type underwrite. And as long as that cash flow will cover the mortgage on the house, and they have good credit and a little bit of reserves, then we're going to give that borrower a loan, either in a purchase scenario or cash out even. So very common. Lots of investors out there sitting on a lot of investment properties. In fact, Frank, I know a lot of people that paid cash for these properties that now they've seen the appreciation. They'd love to tap into it, but they just don't have the agency guidelines to tap into their equity. So this investor cash flow is a really popular product for us.
Definitely.
Yep. So here's just kind of a visual on the different kind of non-QM borrowers that are out there, investors. We talked about the credit seasoning, bankruptcy, foreclosure, the self-employed, obviously the bank statements, low credit scores, asset qualification. We even have a product that we look at just their total assets, and we use those assets to qualify them for a mortgage. We're not looking at their income if they have significant assets. So one key, and everything that we've talked about thus far is really to market yourself. I could see the scenarios that Barry ran through. Get these products out to your database, in front of your networks. But marketing yourself is a really critical key to success in today's market. And so we've created all kinds of collaterals, flyers. We have presentations, in fact, right here. It shows a realtor's untapped market. That's for you as an originator to give to realtors. And it's a PowerPoint. It says nothing about Angel Oak. And if you're a customer of Angel Oak, you have access to this, and we're happy to share that with you. So marketing is really the key in today's environment.
So I got some questions, and I think you're heading this direction, but we might as well just throw them out there. Perfect. Yeah. You're going exactly where the questions are leading you, just by coincidence.
Perfect.
Here. So yeah, they want to know real quickly on the bank statement loan. Are those personal or business? They also
either one. We can do either personal or business. Can't do both, but one or the other for any borrower.
Okay, great. They want to know how they know if they're approved with Angel Oak. Can we touch base on that one, or?
Sure. Here's one takeaway from this website or from this webinar is our website, angeloakms.com. Anybody on the call can go there right now. But this has lots and lots of resources for you. But to find out really if you're approved with us, the easiest way is to go right here, contact Angel Oak, and it's a tab that says Find an AE. And so, and just so everybody is clear, we are a wholesale and correspondent lender. So, but this is a map of the entire country, and all you would do is click on your state. If you're in Texas, you'd click on Texas, and there you go. And our sales coverage for the state of Texas pops up, and you can find out, which market, and you can contact them. There's John, our regional sales manager, but they'll let you know if you're approved. So that's kind of a first step. I would recommend anybody who wants to do business with Angel Oak, start there. To contact Angel Oak, go to the map, and then you're going to find who you need to reach out to. we talked about those presentations to realtors. We have AEs very often that are attending those presentations with the loan officers. So realtors love hearing about these products. So any other questions that you see coming across, Frank, before we jump into the next area?
Well, they're talking, FICO scores. You know what I mean? So if you're heading to Quick Quote, that would be a good segue for that.
Okay, so let's do that. Yeah, so probably the most used location on our website is right here. It's Quick Quote, and that's a great segue. But when you go in there, you would just put in your company name, and that's another way you can find out if you're approved with us, is you would put in your company name. But put the company name, and all that's really doing is checking to see if you're approved with us and if you're approved with lender paid compensation, and I'll show you where that comes up in a minute. So the mortgage company I put in there is not approved. But so what this tool is, this is a tool for you to get really quick answers. When you've got a borrower who's calling you and you've pulled their credit and you see a situation, or they're a self-employed borrower and they know their tax returns are not, they've been turned down by another couple lenders. So you're going to have to look for something alternative. You can go to this Quick Quote in a matter of a few clicks that I'm just going to show you. You can get answers back to that borrower. So let's just put a little scenario in here. Credit score will say 720, loan amount, let's go 453 to 750. Loan to value, let's say you're looking for a 75. Their housing history is good, no lates in the last 30 days. And as soon as you answer those questions, products start popping up. And you can see there on the bottom of my screen how they pop up, the different ones. And we throw a little bit of information to differentiate, but our platinum product at 75%, we need 4 years seasoning from a bankruptcy or foreclosure. What's interesting here as well, though, is that it shows you 75%, and our rate on that one is 4.99, but it also tells you you can take this borrower to a 95 loan to value. And remember, no MI. So all the options are right here. Let's say instead of full doc, it's a 12-month business bank statement borrower. So you click that, and it automatically changes right here what the scenario looks like. So we're at a 5.374 rate. Again, 75, we can do it to a 90%. And so we call it Quick Quote for a reason. It's extremely quick, answer a few questions, and then just have an idea that, okay, this is something that I could get done through Angel Oak. What do I do next? So what you do next is right here on this page. Right here, it says pre-qualification request, and the arrow turns into a little pointer finger, and you just click on that. And when you do that, that takes you to the next page, where all you do is put in, you select your account executive from all of our executives listed there, put a little bit more information about the deal. You upload the 1008 and 1003 and credit report. If it is a bank statement loan, you can actually upload the bank statements right here, and we'll do calculations of income for you. And then you click submit. And when you hit submit, it goes to your AE, and you'll have something back in writing in less than 24 hours with exact terms for that borrower that you can then start taking the application to get the loan going. So real simple. That's why we call it Quick Quote.
Yeah, we've got a question here about down payments. Someone's saying obviously the purchase advantage is here. Can they be gift? Do they have to be seasoned? What's your deal with down payments, reserves?
Gifts, we can allow 100% gifts on our program. So that is very common. Seasoning, we require 30-day seasoning. So we're only looking at 1 month's bank statement. But gifts are allowed and happen on our programs all the time.
So here's a good one. Can you use the cash out as the reserves?
Without a doubt. Yes, you can.
There you go. Here's a good one. This is Graham. How about a divorced client who doesn't have seasoned alimony income? So I guess maybe recently divorced, just starting to get some alimony income.
Yeah, we're going to, from an income qualification standpoint, we're going to follow Fannie's guides on that.
Okay. which leads to a great next question. Do you do Fannie Freddie deals, or FHA VA deals, or just non-QM?
Actually, no. That's a really good question because we think it's really important. We've been doing non-QM loans exclusively for 5 years. So we believe there's an absolute level of expertise that we have, and it's because we don't do Fannie Mae and VA and FHA and the government loans. So we're seeing there's lenders out there that are offering non-QM, but it's not what we do. We don't offer non-QM. It's all we do. And I think that's something that kind of differentiates doing business with Angel Oak.
There's a great follow-up to that. How's the performance of these loans been since you've been doing them?
Oh, yeah, that is one of my favorite questions because the answer is really amazing. So Angel Oak also we're what we call vertically integrated. We not only originate these loans, but we securitize them through an affiliated company, Angel Oak Capital. And so they're issuing these securitizations, and they're rated by the rating agencies. And Fitch did a study earlier in the year, and they looked at I think it was about $4.5 billion of non-QM loans that have been securitized in the last few years. It was around 11,000 loans, and there have been a total out of 11,000 loans, $4.5 billion in originations. There have been a total of 8 foreclosures.
Wow!
And you heard me right. That's 8, not 8E or 800. It's 8. So the performance is really it's off the charts. So, and we believe that kind of goes to the fact of the expertise. We make manual credit decisions, and we've kind of proven that we know how to do these loans.
Nice. Well, that's about it, man. Unless you have any more to show us.
Yeah, I was just going to show once you're a customer with us, right here at the top, you log in. I mentioned earlier marketing and how important marketing was. Well,
sure.
Let's just show real quick. It won't take long because I know we're all pressed for time and want to get everybody.
Well, I'm going to let you guys. I'm going to let you guys wrap up, gentlemen. Okay. Thank you for having me.
All right, Barry. Thanks so much,
Barry.
Man.
So right here, when you're approved, you'll be given a username and password. But right here we have flyers, and these are customizable flyers. So you can see lots and lots of them, but they can be used. They say nothing about Angel Oak, but right here you would put your logo, and at the bottom you'd put your information about it. As far as how to get in contact with you. But that is what. The successful originators right now, they're taking these flyers, they're putting their information on, they're posting them on social media, they're sending them out to their databases, they're printing them out and carrying them with them when they're out making calls on Realtors. So it's just, it's something to talk about. You're not going out saying, well, I do Fannie Mae and FHA, because that's not really going to differentiate you in today's market.
Definitely, man. Have those in your briefcase or whatever, or in your folder as you're out in the field visiting. Drop them in some boxes, drop them on some desks. It's the way to go.
Yep. So I think we're kind of getting close to the end here, Frank.
Yeah, we've pretty much fielded all the questions. We don't have any new ones coming in here. It looks pretty good.
Okay.
Yeah.
Well,
cool. Well, wrap it up with some contact info or something. Do you have that on one of the slides, or we just get the email?
Yeah, sure. Yeah, right there. So
there you go.
Here's my phone number and email. Anybody wants to reach out to me and ask any questions, or again, use our website if you're looking for your local contact. That's easy to find online. angeloakms.com.
Good stuff, man. Thanks, Tom. Barry had to take off. He's off to other things, so we appreciate having him on as well. Guys, we'll be getting this recorded webinar out to you. We'll get it out with some information on Angel Oak, of course, and some information on MBS Highway. And, geez, thanks for showing up. I hope this was helpful. I thought it was really informative. And stay tuned for more webinars with the National Real Estate Post and Angel Oak Mortgage Solutions webinar series coming up. We got a great one coming up next month. We're going to be talking about residual income in the mortgage industry. What? What?
What? I've never heard of that.
What? Yeah, that's what we're going to be talking about. So, all right, you guys have a good one. We'll be signing off. Thanks, Tom.
Thank you, Frank. Talk to you soon. Thanks, everyone, for joining us.
Bye.
Bye-bye.